Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, welcome back to another episode of Ticker Talk.
Ticker Talk.
We are back with a review of the second quarter.
Yes. And clearly it's Friday. We're both in different golf shirts.
Casual Friday around here. So, you know, unbuttoned a little bit. But so the goal today is to recap what happened in the second quarter, as well as we've got a few other things to talk about. And I just want to start off by saying that we are currently sitting here on July 12th as we're recording this, and the markets year to date for the first half of the year, and when I say markets, I'm referring to the S&P 500, year to date up almost 18.5%.
Holy cow.
And I say that, I pointed out to say we need to be cognizant and enjoy when the market is going up.
Great point.
Not necessarily look for the reason that it's going to go down, and worry, is it too high? Is it a good time to buy? You know, don't bring anxiety onto yourself as an investor, onto ourselves as investors when, you know, you don't need to.
Yeah, actually, I've said at the end of March and then again here at the end of June, people that I've talked to, I said, you know, maybe you should frame your statement. Yeah. You should put it in a nice frame and hang it, and you can just look at it and enjoy it, because, you know, everybody here knows, being investors, stocks go down and up. They don't always go up and up.
Yeah, and the reason that I specified what market I was talking about is because every market is incredibly different, meaning large cap versus large cap value versus large cap growth, or small caps. Not everything has had as good of a year as large cap growth has.
Right. So the S&P 500, Louis alluded to the fact that through today up 18%, but talking about the second quarter through June 30th, the S&P 500 up 15.3%, the NASDAQ up 17.5%, but the Dow Jones Industrial Average only up 4.8%. And if you look at the small companies, those with a market value, say below 20 billion, 15 billion in market cap, that index through June 30th is actually negative, just shy of 1%. So down 0.7% year to date. Therefore, not all markets are created equal. Yes. So that's a great point by you.
Yeah, I think it's important. It's the S&P 500 is oftentimes what you're going to see on television when things are going good, because that is the majority of what people own, because they're the largest companies.
Right, and then within that, we spoke last time about how there are specific companies driving that. So the market weighted, the market cap weighted S&P 500, the biggest stocks are given more credit in that index. And so Microsoft, Apple, NVIDIA are the big three, and each day the number 1, number 2, and number 3 interchange depending upon what's going on that day. But they create an outsized proportion of that index. So it's a virtuous cycle. It's a good thing. But those good things can turn into not good things depending upon what's happening.
Well, and like you were talking about, these biggest companies kind of trade places at number 1 every day, really, as of right now. And in the second quarter, we saw NVIDIA take that number 1 spot for the first time, and that has driven some conversation about, is NVIDIA overbought? Is it? Can you still buy it right now? Is this the Is this the peak? And so I'd love to get kind of your thoughts on that a little bit.
Right, and just as our disclosure says, we're not over here making any recommendations on buys or sells of any of these individual stock. We're just talking about them because they are in these indexes. But one of the things that you have to do, no matter what, insert name of company here.
Yep.
NVIDIA is what everybody's talking about.
Yeah.
But you have to look at the earnings. Does the earnings growth match the growth in the share price? And if it does, and if that looks like that's going to continue, then that's an opportunity for you as the investor to evaluate it on the merits, on the math, not on the emotion, and then make a good decision as it relates to what you're comfortable with in buying or selling.
And the reason that it's interesting to me is, I obviously wasn't an investor in the late 90s and early 2000s, but you see people draw parallels to companies like Cisco and other .com stocks when they talk about the big tech stocks of today. And people will kind of talk about, hey, is this kind of a repeat? Is this the same thing? These companies have gone up so much, the market has gone up so much, but to your point, there are revenues and there are profits to back up these rising share prices.
Well, the key that you just said is that there are profits. There are actual cash flows that are coming into these companies, and these large companies hold an enormous amount of cash on their balance sheets. I mean, we can look at the 10-year numbers on cash for an NVIDIA, and 10 years ago they were holding about $3 to $5 billion in cash. Today, according to S&P research, is $25 billion in cash and going up every quarter because they have a 90% profit margin on everything that they sell. In the .com world, they were going public using the cash they received from the public markets and burning through it, hoping and praying that somebody would come buy something that they were selling online. And it just didn't happen. So very, very different set of circumstances. Very, very different valuation models that we have today. So you shouldn't get a lot of anxiety in terms of, is this 1999? The question is, do you have revenue growth? Do you have cash flow?
Yeah, I think that's a really good point in terms of just not reading too much into what some article may say or what some people on TV may say for entertainment purposes, and really diving into the numbers and seeing value that a company is producing.
Yeah. So again, to sum up that piece, it was a great quarter for the broad markets, great quarter for growth in particular. Not all markets are created equal, but when you have sectors of the market that lag, so right now materials are down, utilities are down, consumer staples are down, industrials are down, then you can rest assured that pendulum will swing, and eventually, if their earnings and their revenues catch up, then those things will eventually do well. And just to be clear, it doesn't mean technology has to come all the way down for those to go up. It may just mean that technology takes a little breather. If you're playing a game, a basketball game, and you're running up and down the court, sometimes you got to come over to the bench, take a breather, get a water, get taped up, and let somebody else do that for a little bit. So I think that's what we may see here a little bit in the second quarter. Speaking of the second quarter, if we could transition into what do we see? So what are we seeing for the second quarter? One of the things, according to Standard & Poor's research, we are looking at estimates for S&P 500 companies to be up about 8% year over year from the second quarter of 2024 over the second quarter of 2023. Well, an 8% rise is really good, and that's going to be in the whole market for 8 of the 11 sectors, I mean, we're looking at close to a 9%
Yeah.
jump in earnings over some of those bigger
Yeah.
sectors.
Well, and I think just because we are recording on the 12th, we've had an 11-day look into the second
Right.
quarter already, and the market has been wanting to see, or investors have been wanting to see the market broaden out.
Right.
Meaning other sectors, as we've been talking about, start to show some earnings and show some stock price appreciation. And to your point, we even yesterday on the 11th saw some of the big tech companies in the day in the red.
Right.
And the market,
They got put on the bench.
yeah, they got put on the bench. They needed a breather. They've been running for 2 quarters straight, or really 6 quarters straight. And we saw the rest of the market pick up the slack. The equal weight S&P, the RSP index, had a really good day, which is promising to see when big tech isn't carrying the water, that the rest of the index can carry its weight as well.
Yeah. So I just think it's important to the markets are always looking forward.
Mm-hmm.
And so you as an investor have to do the same. And if we think about where estimates for the S&P 500 have been and where they are going, you say, oh my gosh, this market's up, 18% after being up 20-something% last year. Does that make sense? Well, in 2023, the earnings for the collective S&P 500 stood at somewhere around 200 to 210. Well, after a little bit of a pullback in 2022,
Yeah.
and then we powered through in 2023 and ended the year up 10% on those estimates. For this year, we're looking at a collective 240. So that's up another 10, 11, 12%.
Yeah.
And then for next year, for 2025, we're looking at 276. So going from 276 in earnings from 200 is a big move.
Huge.
And if earnings are going to be up that much, then it stands to reason that the values of those companies should start to lift and gravitate up that much. So, yeah, we're up relative to where we have been, but it's not super crazy. Now, to be clear, it's a premium.
Yeah.
You need to be, I wouldn't just be jumping in there. We talked last time about dollar cost averaging in.
Yeah.
I still think that's the wise thing to do.
Yeah. And I think we've talked a ton about earnings, but we'd be remiss to not mention the rest of the economy.
Yes, thank
and
you.
Jobs and housing and payrolls. And all of those have also been a factor as to why the market has been able to sustain and continue to grow, because people have a job and their salary's going up, and they, not me, but they own a home.
You'll get there.
And a lot of people own a home at a below 4% rate. And so sure, it's tough to buy a home today at 6, 7, 8%. But the fact of the matter is that the majority of Americans were already in a home before rates went up. And so they may be stuck in that home because they don't want to go move and get a mortgage at 8% now. But that's another contributing factor to these earnings is people have jobs and they have a salary coming in, and that salary is growing.
Absolutely. Absolutely. And so we spend a lot of time talking about things like where the market is, what could happen next. And so we often spend a lot of time trying to figure out what the next sort of yucky thing that's going to happen. Like how do you predict, the crash of 1987? Nobody could have predicted 9/11. Nobody could have predicted shutting down an entire global economy in 2020 for COVID-19. But the flip side is a lot of long-term investors don't look at what the risk is of an amazing application that has been developed that will change the trajectory of the economy as the internet did, the productivity that created, and one that we can sort of put a line of demarcation in the sand is Chat GPT.
Yeah, and AI as a AI as a whole, we're starting to really see the consumer applications of artificial intelligence.
And so, isn't it interesting that in 2022 the markets were down over 20%? By October of 2022, the markets are down some 30% if you were in tech-related stocks. And lo and behold, ChatGPT was released in October of 2022. The NASDAQ is up 75% from that October of 2022 low, and nobody saw it coming. So a big risk to long-term investors is not just what's the bad thing that's going to happen, but you cannot miss the good things that are going to happen.
Yeah. I've got a quote by Peter Lynch written down here. And just to preface it, to hammer home your point, 2022, not a good year.
Terrible.
The bottom was in October, and all of the estimates for 2023 were coming out. Very smart research analysts putting out their projections for 2023. Almost everybody was calling for a recession and a lower stock market. ChatGPT comes along, and the rest of AI and kind of drives that AI catalyst to the market. And 2023 was a fantastic year for the markets. And so all that to say, if you listened to all the analysts and got freaked out and maybe sold, or said, oh, I'm going to wait until after the recession in 2023 to buy because there's definitely a recession coming. Peter Lynch says more people have lost money waiting for corrections than in actual corrections. But the reason being, and I've heard you say it 100 times, bull markets don't let you in.
Bull markets don't let you in, and bear markets don't let you out. The thing you have to do as an investor is commit the capital, know that it's going to be lumpy, know that I could be down before I'm up. But if I stay in over time, then I've got this opportunity to catch that wave of United States companies, industrial, innovation, and productivity. So I agree with you in that regard. Oh, you had some statistics. I don't know if you still have them on.
I've got them. Let's see.
The market on average for the last 100 years has been. I'll let you take it from here. It's like 10%, but take it away.
Yeah. So for the last 100 years, the market has averaged 10.6% return per year.
Man, sign me up.
So super great.
And never goes down, right?
Except for when it goes down.
Okay.
So, but that's an average of 10.6 over the last 100. So over the last 100 years, I looked at the numbers. Actually, full disclosure, Mason Quinn looked at the numbers and then gave me the numbers to report. And over the last 100 years, the amount of times that the market has actually returned the 10% average, twice.
Right.
2 times has it ever returned the actual average, and 7 times has it been within 2% of the average.
So 8 to 12.
8 to 12.
Yeah.
And so the reason I think it's important and what we see, especially when we're doing retirement planning and we're looking at asset allocations and assumed rates of return, that average never happens.
Average doesn't happen. So if you've got a bucket of ice water and you put your foot in it, and the other bucket is boiling water and you put your other foot in it, on average you're warm.
Yeah, exactly.
And that's sort of what returns look like. Down 20%, up 20%.
Yes.
Yeah.
Yes. So. Or flat, and then people really start to wonder what's going to happen. So it's just you can kind of get caught up in, okay, well, yeah, 10% a year, that's great, and maybe I own some bonds, so maybe that brings me down to 7% a year. I think I can withstand that.
Right.
And that's just not what it looks like at all in reality when you get your statements in the mail, which is why you said,
Frame
hey,
these.
maybe frame your statement when it looks really good, because it's going to look really bad at some point.
At some point, so we make money in percentages. Hey, I'm up 10%. I'm up 11%. I'm up 12%. I lose money in dollars. Oh my gosh, you guys lost me X thousands of dollars.
Yeah.
And so just it's important to think through these concepts, understand them, understand your personal emotions, how you'll feel when you open that statement and it's lower, how you'll feel when you open that statement and it's higher. Everybody always feels good when it's higher. But my point is really think through your allocations. Louis, let's, in the few minutes that we've got left, let's talk about the future of interest rates.
Okay.
Nobody knows, obviously, what's going on, but the Treasury yield curve has now been inverted for the better part of a couple of years.
Yeah.
And so that means the short-term rates are higher than the long-term rates. The municipal markets, that market, it looks like a U. So we've got higher short-term rates, lower intermediate term rates, but the long end, the 20, 30-year tax-free bonds are starting now to actually pay you more than the short-term rates. All these things are telling us that eventually those long-term rates are going to be higher than the short-term rates. What we don't know is, will the short-term rates fall to make that happen?
Yeah.
So currently the 60-day T-bill's around 5.25. So will the 10-year go to 5.5%, 6% to make that yield curve normal, or will those short-term rates go back down to 3%, 4%, something like that?
Yeah.
And then the 10-year is around 4 or 5%, making that yield curve normal. We don't know. There's a lot of talk right now about the next move for the Federal Reserve to be a cut in rates. So if you've been enjoying your short-term rates from the Treasury bills, just know that that may not persist. That could change here as we get closer to the end of the year. The other thing to think about as we close this out is we are getting ready to go into, we're in the third quarter, traditionally the most challenging quarter of the year as it relates to returns, what have you, but we're also in an election year. We are not going to talk about.
Oh, are we? I didn't. Is
you
there
didn't
an
know
election?
that? There's an election, Louis.
Oh, okay.
So that's really good. Comes around in November.
Okay.
At least that's
I'll have to look into
traditionally
that.
what we've done. And that is going to create some anxiety for both sides of the aisle or either sides of the aisle. Just know that we go through that every 4 years. We've been doing it for 246 years.
Yeah.
It's going to be okay.
I actually, on that point, I thought it was interesting. I was listening to another podcast with Josh Brown, and he was interviewing a lady who made a really, I thought it hammered home the point of, hey, election years, there's a lot of talk.
Yes.
Well, let's look at the markets when Republicans were in office. It was a $10,000 investment. Only when Republicans were in office,
Okay.
turns to $100,000.
Okay.
A $10,000 investment only when Democrats were in office turns into $500,000. Stay invested when anybody is in office, and you get the upside of both. And so I think that is really important in an election year to kind of talk about. And then also on the rate side of things, just to kind of recap where we were at the start of the year, and to also reiterate, staying invested and not reading into all of the projections all the time, because at the beginning of the year, end of 2023, beginning of 2024, analysts were looking at 3 rate cuts at a minimum, 6 rate cuts at a maximum. but they were for sure coming in March. It's July. and we
Haven't cut once.
haven't had a cut yet.
I'm not sure we get one by the end of the year, personally, but we'll see.
So I just think it's important to hammer home that we don't know what's going to happen.
Yeah.
And if you kind of go in and out of the market based on, well, I think this is going to happen. It's the age-old saying of time in is better than timing.
Amen.
And timing is almost impossible.
Yeah. I've not seen anybody that can do it well, and I've seen a lot of things. So, well, we hope you've enjoyed this segment of Ticker Talk for the second quarter, and we'll see you after the third quarter.
Yeah. See you then. During this podcast, the following individual stocks were mentioned and discussed: NVIDIA, symbol NVDA; Microsoft, symbol MSFT; Apple, symbol AAPL; Cisco, symbol CSCO. Please note that Robert W. Baird Incorporated and Company makes a market in these securities and these companies discussed in this podcast.